Good morning, ladies and gentlemen. A warm welcome to this Nedbank Business Banking webinar, providing an overview of the economy. I'd like to welcome all our Nedbank clients. We thank you for your time. We value your time. We value your business and your relationship. I'm Herman de Kok, Executive Head Sales Business Banking. Allow me to also acknowledge Dave Schweckman, Divisional Executive for Client Network's Northern Division, Badresh Danji, Executive Head Risk and Credit Business Banking, and Gavin Payne, Executive Head Risk, Retail and Business Banking. Ladies and gentlemen, this presentation is going to be just over an hour, after which we will allow for questions. If you look at the top left of your screen, you will be able to click on a link that opens up a window where you can post your question. Please also complete your details as you post your question. This functionality will be available throughout the presentation. So whenever we are on a specific slide and you do have a question, please do not wait till the end, but post your question immediately. We cannot guarantee that we will address all the questions at the end. However, this session is recorded, and we will circulate a recording of the session together with all the questions and the relevant answers in the next week. If you are like me, with 2 teenage daughters at home, your bandwidth might come under strain when everyone's online. If you experience a freeze on the screen, just refresh and it would reset, and you can then again follow the webinar. I'd like to now introduce our key speaker for the presentation, and I'd like to read a short bio. Nikki Weimar is our Chief Economist at Nedbank. Nikki has been a Senior Economist at Nedbank since the year 2000. She received a Master's in Economics from the University of Stellenbosch in 1994, and soon advised government on economic procedures and policies in a capacity as an economist in the Central Economic Advisory Service, since integrated into the President's Office. Her experiences in the banking, securities and brokering industries ensured her broader knowledge of a wide range of fields within economics, including sector analysis, fixed investment trends, and the relationship between real economic trends and developments within the financial markets. At Nedbank, Nikki has focused most of her energies on trends in the overall economy, looking at cycles in economic growth, inflation, and interest rates. She regularly does talks all over South Africa to a variety of audiences, like business forums, property groups, large corporate firms, and government entities. And it's now my pleasure to hand over to Nikki.
Good morning, everybody. So my job today is a rather bleak task I have ahead of me. I have to give you a quick update on how this economy is faring in the times of pandemics and lockdowns and all of these dramatic disruptions we've had to economic activity. So the way we're going to go about it is we're going to start looking at the global picture, what's been happening in the world economy, what's been the financial fallout, what's been the economic or real economic fallout, and then we're going to look at a quick summary of how this is likely to play out in terms of the forecasts that are out there at the moment, and then we'll narrow it down and we'll focus on South Africa specifically. So let's start at the beginning. We are living in unprecedented times, in historic times, not for good reasons, unfortunately. We are dealing with the COVID crisis, and as you can see, it's spread across the globe very quickly. It started in Wuhan, China, and from there, the second sort of epicenter of the virus was Europe, and currently it is North America, specifically the United States. As you can see, looking at this particular graph, which shows you the total number of infections that have in fact been confirmed, so confirmed cases of COVID-19 across the globe, we are now over 4 million infections, which truly is a dramatic figure. Sadly, this virus has cost the lives of many, many people. And at the same time, it has caused incredible damage to the livelihoods of many people across the globe. Despite this very grim picture, there is some hope emerging if we look at the rate of new cases reported. In other words, this is the bit that really gives us a sense of whether the authorities across the globe are getting this problem under control or not. It at least looks as if we're no longer on that steep rising part of the curve, the accelerating part of the curve. We are gyrating near the peak. And that has given the market some comfort. It's given investors a little bit of hope that maybe soon we can actually comfortably say that the worst is over. It's too early to draw those conclusions, and as you can see, one can sort of hover around this peak for several weeks at a time. So it takes time to beat this virus, and but the fact that we are no longer, as a globe, as a world, rising, that is what's given investors some comfort. We've seen this very same pattern across Europe, and in fact in Europe they are now starting to enter the downward sloping side of the curve. In the United States also, it appears as if the worst is over, as if the rate of infections there have reached its peak and it's now gyrating at that peak. Of course, there are many different views on what is happening in the United States. There are those that are saying that they haven't tested nearly enough people to draw those sorts of conclusions, that the number of tests they've done per million people are insufficient to come to any kind of conclusion of the true prevalence of the virus among the population. Nonetheless, if we look at what has happened in places like New York, where really has been the virus and the outbreak has been concentrated there, it does appear as if the worst is over and life is slowly starting to return to normal. And so what we've seen across the globe is that some countries are preparing to ease their containment measures, to lift restrictions slowly. We've seen this in Germany and Belgium and the Netherlands and Italy and even in Spain, where they've had a few waves that they've had to deal with. Of course, in China, everything has been opened for business. Factories have been opened to people. Retail stores and shopping malls have been opened. People have been allowed to travel between provinces. Some countries have dealt with this problem very effectively, like South Korea, Taiwan, where they never really had to institute any kind of lockdown, just simply by detecting it early and doing the tracking and the tracing and placing those that have been exposed to an individual with the virus in quarantine. Australia and New Zealand have also dealt with the problem very successfully and, in fact, reopened their economies. So the world has taken some comfort from that, especially from the fact that the US appears to have put the worst of the rapidly increasing rate of infections behind them and appears to be gyrating around that peak. And as a result, we have seen some improvement in market sentiment. We have also seen some corrections. In the midst of the COVID-19 panic, equity markets plunged, and your global investors literally wanted US dollars and gold. That's it. And some of them also just wanted to hold low-risk countries' government debt. That's it. Those were the free preferences. And they sold out of anything that even had a hint of risk attached to it, including, of course, equity markets across the globe. So they took a mighty hit in mid-March at the sort of peak of the panic, and as investors started to realize that COVID-19 is going to have a dramatic impact on economic performance and most certainly on company earnings. Since then, though, as it's become clear that we are gyrating around that peak, we are no longer on the upward sloping part of the curve, you have seen that in fact, equity markets have started drifting higher. So there's been some correction from that blind panic that we experienced in March. Although the point has to be made, if you look at this graph, we are still very far off from the levels that prevailed prior to the COVID-19 crisis. Just to show you that preference for sort of safe assets, your sort of safe havens. What we've seen is a return to low-risk countries' government debt. even though the interest or the yields you are getting is an pittance. It really is an insult of a return. In the case of the US, they are less than 1%. In the case of the UK, they're about half that of the US. And in the case of Germany, they're in fact negative. So you are buying an asset that has got a negative yield. And in essence, you are paying the German government for the privilege of financing their debt. So that gives you a sense of exactly how bizarre the situation is at the moment, and how there is still this underlying risk aversion and nervousness, because nobody quite knows how this pandemic will play out, and ultimately which companies will survive this crunch and which won't. And so as a result, there is this preference for government debt. One industry that's been completely disrupted, of course, have been global oil prices, and the global oil industry going for the worst crisis they've had in 80 to 100 years. During the past week, we've seen that Saudi Arabia announced again that they're going to cut oil production by another 1 million barrels a day, in a hope, of course, to maneuver and manipulate this oil price up a bit. It's off its very, very lows, but it's still traveling or floating around that sort of $30 a barrel and slightly less level. Our view on oil prices is it's simple. They're not going to recover in a hurry because the demand in the global economy is simply not there. So they'll probably slowly drift higher in the months ahead, but it's going to be a very slow normalization, regardless of how many barrels of oil production the Saudis cut or not. The demand in the world economy isn't there to support rising oil prices. And of course, this poses somewhat of a deflationary threat, especially to your advanced countries. And we've already seen in the US, the recent inflation numbers have been much lower than they anticipated. And of course, in Japan and Europe, where the inflation has generally been hovering very close to deflation levels, the risk of deflation is that much greater. So oil prices collapsed, and the other thing investors, of course, preferred, without a doubt, has been gold. So we've seen that gold prices have had a very nice rally, and in fact it's remained robust. It's holding value. Most other commodity prices, along with oil, have taken strain, but you can see that platinum prices have also recovered a little bit. It's retraced some of its losses, but again, nowhere near the levels where it was before this crisis struck. So gold's done well. Government bonds, especially low-risk government debt, has done well. And then, of course, everybody wants dollars. This is the US dollar against the euro, and you can see how it's been very erratic. And those moments where the dollar dips, that's where the US Fed is trying its very best to keep the dollar under wraps and to prevent any sharp appreciation in the value of the dollar, because that's the last thing they really want. So they've gone as far to create, for the first time in their history, an international swap facility, where they say to countries, listen, if you've got collateral that we find acceptable, come to our swap facility, we'll give you dollars. That's literally what they've been saying. So as you can see, there's been an effort to keep the dollar steady, and despite that, everybody still wants dollars. So despite this huge effort to really manipulate the dollar weaker, it doesn't seem to have worked because of this risk aversion in the system. And the policy response to all of this disruption, of course, have been to try and reinflate the world economy, to try and get at least maintain some level of confidence in the system until the lockdowns are over, so that the world economy can rebound from all of this disruption quickly and rapidly. So one of the things they've done, of course, across the globe is they've slashed interest rates. In your low-risk countries, interest rates were already pretty low. Only the United States had considerable scope. They were the first ones to wake up to what impact, in fact, COVID-19 would have on economic activity across the globe. So they slashed the interest rates by 150 basis points. The interest rate now, the Fed funds target rate, is only 0.25%. That's it. Then the UK followed, they cut interest rates, and then poor Eurozone and Japan, they don't have an interest rate to speak of. It's already negative. And that experiment hasn't been very successful in promoting and accelerating economic activity. So their scope to cut interest rates further, very limited. But, of course, you can always print money. So your central banks, your major central banks have started the printing presses up again. The steam's rising off it as they're going about it. And what we have seen is huge liquidity injections into the financial markets. And in fact, the US Fed has gone so far that they are now, for the first time, buying corporate debt. All right. Just to keep liquidity in the system. This shows you the US monetary base, and you can see that acceleration that occurred, now over $3 trillion being pumped into the system in an attempt just to keep the liquidity there and to at least keep confidence up, with the hope that once you lift the restrictions for COVID-19, then the world economy can take off again. All right, so that's what they've done. And the other thing that most of your advanced countries have done is they have introduced quite aggressive fiscal stimulus. In the US, a lot of that's been focused on getting ventilators, getting personal protection equipment for health workers, and just preparing the healthcare system essentially to deal with COVID-19. And then also a lot has gone towards unemployment insurance and providing some income to those that might have lost their jobs as a result of COVID-19, and to companies in distress. The fiscal stimulus in the US is at about $3 trillion, so it's massive. It's really unimaginable to those of us that live in developing countries. Nonetheless, $3 trillion, and even in Italy, that really can't afford to aggressively stimulate their economy, they introduced a package of forbearance where they paid 80% of the salaries of all of those that may have lost their jobs during the lockdown. So we've had aggressive fiscal stimulation coming through, and all of this, the monetary easing, the fiscal stimulation, the injection of liquidity through quantitative easing, all of that, of course, has made it possible for emerging markets also to cut interest rates. And we've seen that across your major emerging markets. Interest rates have come down quite significantly, including in South Africa. But what will be the economic impact of all of this drama? Well, China gives us a first sense of what we can expect, because remember, that's where the virus originated. They were the first to go into lockdown. They had their most severe or significant period of lockdown in February, and you can see the economic impact if you just look at these graphs. There's industrial production. In February, when they were under complete lockdown, industrial production fell by over 10%, almost 14%. And even in March, as they opened up, industrial production still remained weak because demand did not recover. All right, retail sales is the problem. So even though you're lifting economic activity, consumers and households, they remain weary, they remain fearful that they might contract the virus. Also, their income has taken such a hit during the lockdown period that they're not willing to go out there and spend large sums of money. So even in China, we saw, even in March as they opened up, you still had a decline in retail sales of almost 15-16%. And of course, what this resulted in is that China's GDP contracted for the first time in multiple decades, right? So consequently, a very, very dire warning of what South Africa might face going forward. This being a far bigger, far more flexible, far more competitive economy than ours, and that's been the impact that COVID-19 and lockdown has had on that economy. We're also starting to see the evidence roll in from the Eurozone and from the US. Remember, the world's not going through this phase in a synchronized manner. Some countries have already been through the worst and they're emerging from COVID-19 and lockdown. Others entered, a little bit later, and they imposed containment measures later. So the US had really only started to feel the virus in any meaningful way in March. They were fine in January and February. They largely ignored its presence. And then March and April, very similar to South Africa, they actually felt the effects of the virus, and containment measures were implemented, social distancing, and in some states lockdown. And as you can see here, just March alone was enough to wipe out all the gains they had in retail sales over January and February. And retail sales in the US actually contracted by 5.8%. A similar story with industrial production. Just March alone took us to a decline of 5.5%. So, January and February, the US economy was still expanding at a rapid pace. Then came COVID-19, and then came social distancing, then came lockdown, and that 1 month dipped the entire GDP into contraction territory, and they contracted by 4.8%. But things are about to get even tougher. The numbers we will see coming out of the world economy in the second quarter are going to be the stuff that nightmares are made of. And I say this because this is what happened in April, right? Now, April was the first full month the US went through lockdown. In March, they shed 842,000 jobs. In April, they shed almost 20 million jobs. It is staggering. You cannot even wrap your head around it. You can barely present it in a graph. Okay, that pushed their unemployment rate up from 3.5% to 14.7%. This is among the highest unemployment they have seen since the Great Depression. And during the Great Depression, that dominated 5 very tough years and almost an entire decade, only 2 years was unemployment in the United States that high. Okay, so that gives you an idea of the effect. So what does this mean for the US, for the Eurozone, for all of these countries where you've had these dramatic job losses? Very simply, the burden on the state just is amplified disproportionately. That's the first thing. So we're going to see a rise in government debts. We're going to see very eased and relaxed monetary policy. You're going to see significant deflationary pressure. You're also going to see that consumers, they don't have a job. They are eroding their savings. And ultimately, therefore, they don't have the ability to spend. And demand is going to be permanently weaker throughout 2020. The anticipation at this point is that the world economy will bounce back as we enter 2021. So these are the market forecasts out there. That little red bar, shows you the worst market forecast out there. So the most pessimistic forecast in the market, and then the green one shows you the most optimistic forecast, and the yellow one is the medium. And as you can see, I show you the numbers for the world, the US, the Eurozone, the UK, Japan, and China. And most of your investors and your forecasters out there and analysts in the market, they are essentially the most optimistic about China. They think China will still manage to grow. They will make up the deficit they experienced in the first quarter, and then they'll accelerate in the years ahead. But for everybody else, they are expecting very steep recession. But I've got to tell you that economic models cannot forecast this kind of crisis, this kind of shock. Just to illustrate to you why I say that, look at the forecast for the United States. The difference, the variation between the worst number out there and the best forecast out there in the Reuters poll is 12%. That is enormous. And that shows you the level of uncertainty, that even analysts don't really know how this thing will play out. The next graph shows you the IMF's forecast, and this is a little bit different. The green bar shows you what happened last year, so by how much did the world economy grow last year. The red bar shows you their forecast for this year, and the yellow bar shows you the forecast for next year. So you can see they're expecting the world economy to shrink by 3%. So COVID-19, lockdown, social distancing, all the containment measures we've been compelled to adopt will result in deep recession in global terms. The good news, though, is they expect the world economy to bounce back. I have to tell you, I read the IMF site religiously, and they've recently said that they think it's probably going to be worse than that 3%. That in April they probably underestimated the impact COVID-19 and the containment measures will have on the world economy. So that is really bad. Remember, global growth of 2% is considered recessionary conditions. We are now talking about a contraction of 3%, and it's probably going to be worse than that contraction. You can see for advanced countries, they're expecting a decline of 6.1%, and then only growth of 4.5% the year thereafter, which means they don't see advanced countries going back to the levels that prevailed prior to this crisis. So some permanent damage is left as a result of COVID-19. They're more upbeat about emerging markets, mainly because they're very optimistic about China. And they think that China will get through this without a recession and will accelerate dramatically given all the stimulation measures they've put in place during the course of next year. That's really the IMF numbers, and we are looking at a situation where the world economy is certainly going to enter recession this year, and then should slowly start to recover during the course of next year. The next slide really shows you all of the sort of detail from the IMF. I'm not going to talk through that. That is for your benefit. As I said, there will be a recording of this presentation. You can also ask for a copy of it if you want to, and we'll gladly send it through to you. I'm now going to zone in on South Africa, and let's deal with some of the issues around that. Okay, so as far as South Africa is concerned, our rate of infections really is progressing at a very similar pace than the rest of the world. Our curve has been a little bit flatter, partly, of course, because we have experienced we acted a lot quicker. That's been the big difference. But as you can see, we are still about 2 months behind the rest of the world. So we are still on that upward sloping side of the curve. So we are not near our peak at this point. So for us, there's still a way to go. At the moment, government's estimating that we'll reach our peak around September. And as a result, of course, we're a little bit behind the rest of the world as far as that's concerned. And of course, in our case, the impact has been very similar and it's been equally dramatic. Let's just review the financial impact. As far as the world is concerned, we saw that dramatic implosion during the course of last year, and we're probably going to see a similar picture emerge in South Africa. We saw that equity prices took a mighty fall. The good news is that because of the rally in gold prices and some precious metal prices, we've at least seen resources correct. But the sad thing for South Africa is that that has actually not been the case for financials or industrials. We're hovering near that bottom for both of them. If we now go to equities, well, as far as that's concerned, to bonds, you can see what's happened with the bond market. The yield spiked in the midst of the crisis, and since then, of course, we've had this dramatic recovery in bond yields. It's come all the way down to really sort of pre-crisis levels. Now, what's brought that about, though, has not been foreigners delving back into the South African bond market. It's really been the Reserve Bank intervening to smooth that market over. And we know at the peak of the crisis, the bond market actually seized up. And the Reserve Bank had to step in to buy government debt and to help the market to function in a normal way. All right. And of course, as the Reserve Bank stepped in, what we saw is that local asset managers also returned to the bond market. And in March, the Reserve Bank bought 1 billion rand of South African government debt. And in April, they bought 11.4 billion rand of South African government debt. And this graph really just gives you a sense of how they've gone about to essentially try and manipulate the yield curve down. That yellow line, that shows you where the yield curve was prior to COVID-19 striking, and the red curve is what happened when everything seized up. When the global economy and global investors went from risk on to risk off. And we just saw money flee from South Africa, investors selling out of South Africa, and the bond yield surged to that red line. And ever since then, the Reserve Bank have been trying to manipulate it down. It still remains a very steep yield curve, but at least it isn't at the absolute levels where we've seen it before. But the one thing to bear in mind is that all of the buying in the bond market is really being done by the South African Reserve Bank and by local investors, not by foreigners. This shows you net foreign purchases of South African bonds and equities, and you can see foreigners have been selling out of the South African equity market for a very long time. And when COVID-19 struck, they started selling out of the bond market. All right. Until that, or prior to that, we saw that they really returned to the South African bond market because we offer good yields. But when all of that risk came to South Africa, there they went and they sold out. And of course, all of these capital flows are reflected in the value of the rand. So we've seen the rand take a big re-rating to a lower level. It's depreciated by over 20% from the beginning of the year. But can you see, against both the US dollar and the euro, it looks as if the rand has reached its bottom. Okay? If we look at this particular slide in the value of the currency, how does it compare to previous rand crises? Well, it's a bad one, I can tell you that. This graph, okay, in this graph we look at the rand's movement during every crisis. We start to track the rand's movement from 30 days prior to the crisis hitting. And we have for you here the 1996 rand crisis, the 1998 emerging market crisis, the 2001 rand crisis, which you recall started really with the dot-com bubble bursting, and then, of course, the Argentinian default, and then, of course, our neighbors in Zimbabwe started their most aggressive sort of land grab program, and there was a fear that it would spill over to South Africa, and the rand came under pressure. Then we had a biggie. That was the 2008 global financial crisis, and we saw the rand took a mighty and an extended, protracted tumble during that period. And then we show you Nenegate as well in 2015 here, and then this year's crisis. And you can see is it the black line with a yellow dot in it? And you can see that it's actually fell faster than we saw during the global financial crisis. But it does appear as if it's now bottomed out and it's starting to move sideways. So the worst is probably over for the rand. But the one thing we do not believe is that the rand will go back to sort of the 16 rand level to the US dollar. There is this theory out there. A lot of forecasts in the market, they're essentially saying the following. Listen, the worst is in the value of the rand. Okay, all the bad news, it's now in the value of the rand. COVID-19, global shift from risk on to risk off, that's in the value of the rand. And essentially, we also have in the value of the rand South Africa being downgraded by Moody's and us going to universal junk status. We also have in the value of the rand the fact that South Africa got downgraded even deeper into junk status by S&P and Fitch. So they're saying, listen, all the bad news, it's in the value of the rand. And South Africa offers a return of 7% on its government debt, whereas the US offers a return of less than 1%. And the argument is that this will revive the carry trade. Investors will come to South Africa. They'll put their money in our bond market in order to get that higher yield. And, of course, if you're buying government bonds, you're buying rands. So the rand will strengthen, it will have a nice rally, and it will end the year. Most forecasts put it at around 1620 to 1650 to the US dollar. We don't quite share that view, and I'll tell you why. We think the rand will certainly, the worst is over. We think that the bulk of the bad news is, in fact, in the value of the rand. We do see the rand pulling back a little bit, but we only see it strengthening to about 1780 to the US dollar by the end of the year. And then to slowly depreciate at a far more gradual pace in 2021, 22, 23, in line with inflation differentials. But we certainly don't see it going to 1620, 1630 to the US dollar. And the reason for that is that this time is very different from 2008. In 2008, South Africa entered the global financial crisis with a budget surplus. A tiny one, but a surplus nonetheless. We had debt levels at 30% of GDP. We've forgotten what that is like. We were in fiscally a very strong position. Where are we now? Well, COVID-19, the economic lockdown, it is going to devastate government revenue. Tax revenue is probably going to fall short by an enormous amount of money. At the same time, government is spending more money in order to deal with the crisis and to support people during the lockdown. And therefore, we think the budget deficit is not going to be a small surplus like it was during the global financial crisis, but it is in fact going to be and swell to a deficit of 14% of GDP. And it's going to be very difficult for government to essentially bring that down to a more acceptable level. And your debt burden is probably going to rise to close to 80% of GDP just this fiscal year. And from there on, it will continue to climb unless you institute some specific changes. All right. And part of the problem, of course, is that South Africa has entered this situation where the risk attached to our fiscal situation is just worse. And this graph illustrates it to you. It shows you the 3-year CDS spreads of South Africa, Brazil, Turkey, and Russia over that of the US. And this is your credit default spread. So it's saying how much greater is the risk in these countries of them defaulting on their debt than, say, the United States. And there you can see South Africa is considered one of the most riskiest countries. We are trading in line with Turkey. We are perceived more risky than Russia and Brazil, which is quite a feat to achieve that. And I think that that is in the value of the rand, which is why I don't think it's going to go back to 16 rand to the US dollar. So the response to the global crisis, the response to the South African crisis, to the fallout in the financial markets, to the anticipation that this economy will take a big hit, is, of course, that the Reserve Bank cut interest rates. They've cut by 225 basis points. They've also intervened in the money market. They've also intervened in the bond market, as I've mentioned before. For the first time in multiple decades, they've started to buy government bonds in order to ensure that that market functions smoothly. And then, of course, government has announced its 500 billion rand stimulus package, which you're all very familiar with by now. It is mainly, it's not really a stimulus package, it's a support package. Most of the spending is aimed at preparing the healthcare service for the anticipated acceleration in COVID-19 cases and to deal with that rate of transmission at its peak. And the rest is aimed really at providing some level of income to those that have been severely affected by the lockdown, that have lost their jobs or lost their income as a result of it, and to support companies that may have fallen into really difficult times as a result of the lockdown. Will any of these stimulus packages have any sort of meaningful impact on economic growth? No, it won't. There's no point cutting interest rates when you still have a lockdown. Cutting interest rates is not going to make a big difference to someone who lost their job. Okay, it is the lockdown that matters. Now, our lockdown's been quite unique in that we've done it in a very different way. The way government's gone about it is they've introduced these levels, level 5, all the way through to level 0, I assume, or level 1. And, of course, level 5 is the strictest, and then that's basically complete lockdown other than essentials. And then you have a slight, this gradual easing of restrictions until you get to level 0. And in this, the focus of government has been on really going about it by allowing product by product activity to take place. In other words, you can buy these products, but you can't buy those products. This industry can operate to about 20 or 50 or 30 or 100% of its staff capacity, and those can't. Right? But in the process, they've, of course, forgotten that businesses don't work that way. You may allow agriculture to operate. Just for example, you can allow agriculture to operate at 100% of its capacity, but they need somebody to transport their goods to the ports, to export. They need the ports to be open for that to happen. They need somebody to take their goods to the shops. They need the shops to be open for that to happen. It's the same with motor vehicles producers. Automotive producers are now allowed to operate and to ramp up their production, to 50 or even 100% of capacity. But of course, up until very recently, the dealerships were left closed. So if you're a motor vehicle manufacturer, why on earth would you ramp up production? Already from April, you're sitting on a pile of stock you haven't sold yet, and your outlet through which you sell it, the market through which you sell it, is closed. So it is this narrow product by product, sector by sector view of writing regulations regarding the lockdown that has caused a tremendous amount of unnecessary damage. Okay, and this table really tries to illustrate. It shows as we went from level 5 to level 4, which industries were allowed to operate at what level of staff capacity. And you can see that during level 5, we were only allowed to operate at less than 50% of staff capacity as an economy in totality. And now at level 4, in theory, we're going to about 60% of capacity. What percentage of the economy is that? That's the next set of columns. We show you the percentage of the economy weighted by each industry's share in the economy, the percentage that is theoretically allowed to operate. Okay? And again, it doesn't look too bad. So Minister Patel looks at that and says, I don't know what people's problem is. I've allowed almost 64% of the economy to theoretically operate. But of course, it's not as simple as that. You also have to bear in mind the whole supply chain. So the motor vehicle manufacturers is a good example of that. To open up production for them, but not open up the dealership, doesn't make sense. And it's almost like government's lost sight of the true objective here. Let's think of a motor dealership. Is it a place overwhelmed by human bodies, even in a buoyant market? No. I think it's pretty easy to maintain a 1.5 meter distance. And that should be the focus. If companies can meet the health protocol, and you can make that as strict if you want to, if they can prove that they meet it, and you enforce it as government, and you do your spot checks and your random checks, and you're happy that those requirements are fulfilled, they should be able to operate. Otherwise, the damage is simply just too significant. The other thing with expecting industries to operate at less than full capacity, for example, for mining, it's pointless. Some of them, if they're underground, can now in level 4 operate at 50% of capacity, and the others, if they're open cast, can go to 100% of capacity. But if you're a mine, to operate at 50% of capacity is the most nonsensical thing in the world, because you take on all the production cost and you earn only a fraction, a teeny-weeny fraction of your income. So it makes no financial sense whatsoever. All right. And even after they lift the lockdown, what will decide whether a company will increase production and operations or not? Well, firstly, what your current stock levels are. You might have a lot of stock you need to flog. And secondly, whether your supply chain is open. Because if you can't get the inputs you need for production or to sell, then of course that's going to make things very slow. And thirdly, what you as a firm think is going to happen to demand. If you don't think demand's going to recover, you're not going to up production. So the economy isn't a static thing. It is a thing that is alive. It's a dynamic thing. And therefore you can't view it in a static way. And I think that is where government has done quite a bit of damage. Encouragingly, the President has acknowledged that some of these mistakes have been made and has promised that over the next couple of days we will see some relaxation of those restrictions, even under level 4. And it looks like they are going to allow some degree of e-commerce. We are hopeful about that. And we'll see what else is permitted over the next 2 weeks. But in theory, we stay in level 4, which is still pretty much a stranglehold on the economy, until the end of May. And only at the end of May is there the prospects that some whole supply chain might be released from lockdown. And maybe some kind of improvement in economic activity can start to filter through. But as I said, there's going to be indirect consequences. And those consequences will not easily be turned around in the case of South Africa. One of the saddest things of the lockdown is that a country that already had historically high levels of unemployment will probably have even higher levels of unemployment as a result of the lockdown. We are forecasting that 1.6 million jobs will be lost just through March and April, and that it will take 3 years to return to the levels of employment that prevailed prior to the lockdown. All right? That has implications for disposable income. So disposable income will take a big hit. Now, government's transfers in the form of child welfare grants, old age and disability grants, and also the COVID distress grant and the UIF payments will prop up income to some extent. It will prevent it from being such a steep fall as we saw in unemployment, but it's still going to be a mighty tumble. and it's still going to take about 2 years to get back to the sort of levels that prevailed prior to the crisis. And of course, that means demand will be weaker. How severe will be the contraction in the economy? Well, motor vehicle sales gives us a bit of an indication of what could happen. In April, no dealerships were open. So far in May, no dealerships have been open. So in April, motor vehicle sales down 97%. All right, that's what we're looking at. That little table there, you can take your time and go through it, but it just shows you for the motor vehicle industry to get back to just about 50% of the sales that prevailed prior to the crisis. In other words, a half of the sales they used to be able to maintain prior to the crisis, prior to the lockdown, means that they will have to grow at phenomenal rates on a consistent basis every single month from May till the end of the year, which seems extremely unlikely. And that's why we say there's a permanent hit here. It's going to take at least a year to get back to any kind of normality. Similar story for retail sales. You would also have to grow at a very rapid pace to get back to the sort of levels that prevailed prior to the crisis. And it's also probably going to be about a year before you get there. So what does all of this mean? It simply means that this economy is going to shrink at a very, very severe pace. And some of this weakness will be sustained in the years ahead. It will stay with us. Some companies will permanently close. Some jobs will permanently be lost. And the sooner and the quicker we can move to a more sensible form of lockdown, all right, the quicker and the sooner we can reduce the damage to this economy. So we've got a contraction of 7% for this year in GDP, and then it only recovers about something between 2.5 and 3% the year thereafter. So we stay at a weaker level in the years that follow. So we've got a deep U. We've got something between a deep U-shaped recession and an L-shaped recession. Some sort of mixture between those two letters, if you like looking at it and thinking of it in terms of letters. In terms of PCE, that's probably going to contract by about 2.5% this year. And unfortunately, capital expenditure, that's where you'll see the big hit. That's probably going to fall close to 15% this year. On an industry perspective, I show you the fallout here. Obviously, some industries will be very, very vulnerable. Those that are likely to stay under lockdown for an extended period will take the biggest hit. That would be things like the aviation industry, the tourism industry, hospitality industry. That's where we'll see the biggest pressure come through, because these will be among the last types of activity that will probably be allowed, unless they come up with innovative ways to make all of this happen. The cruise ship industry, that's also going to be hit and affected very severely. Construction, because of the plunge in fixed investment activity. Durable goods, because of the fall in household income, which will make it a lot harder and more difficult for people to get the debt or the credit they need to fund a new car, to fund a new house. And even if they could get the credit, they might be weary to do that because they're not certain what's going to happen to their earnings in the years ahead. So those are, in our opinion, the most vulnerable industries. And obviously, those industries like professional services, like finance, like communications, like IT, your ICT industries, like your professional services, all of the industries that could quite easily function and switch to working remotely and still continue their business, they will probably emerge from this crisis in fairly good shape. So will agriculture and all the agro-processing, processing industries. They've also will probably prove resilient as a result of this. However, it will be significant. You can go through this table in your own time. That's just our forecast by major industry or sector, and as it builds up to GDP. And then the next slide just shows you which industries will take the biggest hit. I think it's fairly apparent, it makes logical sense, and it's pretty much in line with what I've just spelled out. Those industries that will be the last to be allowed to operate, they will take the biggest hit, and many companies there are highly exposed. And then as you move towards your services that are capable of operating remotely, quite easily. They will be the most resilient, plus your essential goods like food and farmers and agricultural processing and those sorts of products. All right, so what do we think will happen going forward? Will government institute greater sort of support, greater stimulation? What will the Reserve Bank do? Can they ease this pain? As I said, no, not really, not this year. The only thing that will help us recover quicker is if you rethink the way you've done the lockdown and make it more sensible and consider the whole supply chain. Take a holistic view of the economy and recognize that it's a dynamic process, not a static process. But the Reserve Bank will probably give you more relief. So next week, Thursday, we've got the outcome of the MPC policy. We recently reviewed our inflation rate. It looks as if inflation will hit a low of 1.7% in June. We've seen food prices come down. So the pick and pays, the checkers, the farmers have not exploited you. They have not exploited your vulnerability during this time. In fact, food prices have been coming down based on our survey. And at the same time, rental firms have given a discount. We've had a 200 basis point cut in interest rates. That will come through in owner's equivalent rent. And then that massive fall in oil prices. And that's going to take inflation to very low levels, probably 1.7% in June. And thereafter, it will slowly start to drift higher. But it's only going to average 2.8%. And the Reserve Bank targets 4.5%. So it's going to be way below their actual target of 4.5%. So we think next week they're going to say, listen, what's the big threat here? It's not inflation. It is really deep economic recession. It is severe human suffering. Give them another 100 basis point cut. So that's what we're anticipating. That will take your repo rate to 3.25%, which is the lowest it's been, and I don't remember when. Certainly not in the time I've worked has it touched that sort of levels. Maybe in the early 80s, when you did have some negative interest rates come through because of politics and political pressure, but certainly not since democracy. Government's ability to provide stimulus, very limited, because this is what's going to happen to their government finances. As I've already spelled out, you're going to have deficits of over 10% of GDP. You're going to have debt climb to close to 80% of GDP. That's excluding the debt of state-owned enterprises that government guarantees. If you add that, you're over 90% of GDP. So government says they're going to introduce a third phase of stimulus, and that this will be focused on getting the economy moving again, doing infrastructure spending, employing people in the construction industry that absorbs a lot of skilled and unskilled workers. But for me, and the reason we remain doubtful about this third phase of stimulus is A, because they have solidly run out of money. The fiscal metrics are highly compromised. And B, government has not provided us with any sort of record or evidence of delivery when it comes to infrastructure spending. For over a decade, they've always promised that they will accelerate infrastructure spending, and unfortunately it hasn't really happened. And where they have undertaken that spending, it's been very ineffective and very slow, the delivery. So I think there'll probably be some delivery on that front, but not enough to provide stimulus. The key here is refocus our attentions on that lockdown, do it in a more sensible way, where companies can show that they can maintain strict health protocols, allow them to operate. That's the key to limiting the damage. But unfortunately, in the short term, there will be some damage. So I encourage you to have a look at our forecast. Phone us if you've got any questions. But for now, South Africa takes a big hit. We all know that already. -7%, it could even be worse. And then slowly recovers. But there is some permanent damage to this economy in the years going forward. That point, that's my story. So I give back to Wynand to take us through the question session.
Nikki, thank you very much. Ladies and gentlemen, we received quite a number of questions, so thank you very much for the participation and posting your questions. Just again, there were questions coming through whether the presentation, the slides will be shared. It will definitely be shared. together with the questions and the relevant answers that we will even address today. You can expect that during the course of next week that we will circulate that. So if I can start with the first question from William Battershill from BSI Steel. I believe SA should embark on aggressive quantitative easing to create jobs and stimulate the economy. I feel inflation is the last of our worries. What do you think, Nikki?
Okay, so I think it's true that this year inflation is not much of a concern at all. And as I said, we in fact anticipate that it's going to average only 2.8%. But here's the problem. You have to ask yourself, how will the rest of the world view a country that historically have many inefficiencies, have huge structural challenges, have very low levels of productivity? In other words, it's not an efficient economy. So therefore, it tends to generate inflation and at the same time sit in a fiscal position that is hugely compromised. If it starts to monetize debt at that rate, how will they view it? Because remember, we are net importers of capital, net importers of savings. Without foreign capital, we cannot grow. And if they view it as destructive, if they view it as something that could potentially promote hyperinflation, not this year, but in the years to come, then I'm afraid it will result in a very negative outcome for South Africa.
Thank you, Nikki. Then Jason Kruger from Kempston Group. Jason refers to the US unemployment numbers, Nikki, that we saw. And the question is whether this is long-term or how much of this is long-term. And the second question I derive from this is, does this include the equivalent to our TERS, our Temporary Employee Relief Scheme, which is only relief for a certain period during lockdown?
Okay, so the provision they've been given is really unemployment insurance. So that's when you would have paid in like we did, and you then get benefits for only a certain period. Yes, that's what it is. So that's the same with the US. Then they've added to that by loosening some of the regulations under this $3 trillion stimulus package, where they will provide provisions to a broader group of individuals, where they may have worked in a sector where they would not have made contributions to an unemployment fund. They will also provide them with support. It is a massive number. The general anticipation out there from the analysts that are experts on the US is that the US economy is flexible enough that once you open it up, it can reabsorb a lot of that labor very rapidly. But increasingly people are starting to think, COVID-19 is a complex problem. We're not going to really have a solution to this virus, effective treatment or vaccine until sometime next year. And that means that we will remain vulnerable. The way people and companies will have to operate will have to change. That will inflict certain cost on firms. So even when the US opens, they may incur costs they never even thought they would have to deal with, just like we do at this point. And so it might persuade them from actually re-employing people at the rate they otherwise would have. So I think even for the US, there is an element, perhaps not as great as for us, but there is an element that will be permanent.
Nikki, there were three questions regarding the tourism industry. I just quickly want to acknowledge Mbulelo Memani from Knysna Municipality, and it's more of a comment acknowledging that Knysna is a very well-known tourist destination, obviously dependent on tourists from the Eurozone. That is hardly it, and want to just get a view on the tourism industry. Then Michael Felton from Kuala Game Reserve, as well as Archie Hitke from Hitgeheim Country Lodge. All want just your outlook on the tourism industry.
Okay. So I really do think, it hurts me to say this because it's one of South Africa's probably most beautiful assets. But I do think that is going to be, you guys face an incredibly tough period ahead of you. Sadly, especially if you're relying on foreign tourism, I think that will be among the last types of industries that will be allowed to operate. And here's the thing, when? Is it third quarter? It's certainly not second quarter. So is it third quarter? Is it fourth quarter? Is it only 2021? It's very difficult to say, but what I hope will happen, and what I hope will provide you with some ease, is that if government says to you, okay, I offer to you Game Lodge so-and-so, the ability to show that you can keep everybody that comes to this lodge safe, you can minimize the risk of COVID-19 transmission, and you can maintain that standard, that you would be allowed to operate. Still, you're not going to see that global travel will be opened, but maybe South Africans will be allowed to, move around, and we'll see greater local tourism. But I think that sadly you're going to have to work on a time frame here that really is probably another 8 months, 6 to 8 months, before I think there's a likelihood of the industry actually being allowed to function in anything resembling what you're used to.
There was a question from Jan de Tooy from the Straat. How does the immediate circumstances influence Nedbank's policy on investment in agriculture for the short and medium term? If you don't mind, Nikki, I'm going to just answer that, since I do have the agriculture portfolio. So, Jan, Nedbank sees agriculture as an extremely important sector for South Africa, not just in terms of food security, but if you look at the contribution to the economy overall, if you look at the contribution to the upliftment of society. So from Nedbank's perspective, our focus and our strategy in agriculture remains intact for the short and the medium term. We have a number of programs to assist not just the agriculture sector, but all sectors to get through the challenges of COVID. But for the short, medium and long term, Nedbank is committed to our role that we play in supporting this very important sector, obviously with the basic normal lending principles and innovation that applies. Then there was another question on agriculture, and this is from Hayden Stokes from Burnview Farming. The agriculture sector, especially the ones in food production, have been operating in a bubble and have not yet been affected by the COVID pandemic. Now the question is, what can we expect going forward, and how badly will the slump be, and when do you think things will recover?
Okay, so we do think GDP will contract 7% this year. And when do we see within that a recovery? Well, in the first quarter, this economy will probably shrink just because of that drag coming from the end of March. In the second quarter, I think we will have a contraction in GDP of close to 40%, probably over 40%. The vehicle sales number gives you an indication of what we can expect. In April, I repeat, vehicle sales fell by 97%. So these are the sorts of declines we can expect in the second quarter. And then from the third quarter, I do think you will see more activity. The second quarter could be better, as I say, if over the next couple of days, those announcements that we have been promised allows supply chains to operate. Not certain products, that's meaningless, but whole supply chains to operate to a certain level. Okay.
I'm going to group another two questions from Dante Mashele from On Trend Media. And Dante's concern is regarding the ability of the leadership in the country to balance the health risk versus the economic risk. And I think the next question from Kobus Verwey from Hill McCarthy and Herbst also relates to that. He says, Nikki, thank you very much. Your input is extremely valuable, to the point. The question is, was our government not advised by experts as yourself on the differences our economy will experience with these draconic limitations on our business?
Yes. Okay, so yes, that's the answer. I think there's been a constant stream of business organizations from BUSA to Business Leadership South Africa. Our CEO, Mike Brown, he has been in conversations with Minister Padel and with our president as well, President Ramaphosa. So I think submissions have been made. Consultations have occurred repeatedly. Business have done, they've got actuaries in, they've got experts in to model what the consequences will be. We've even seen Dr. Karim, who is an absolute hero as far as I'm concerned, in terms of his fight against HIV/AIDS in the 90s and the successes he had there. And he's the chief advisor to government, saying, listen, at some point, you're not going to prevent COVID-19 from rising. As you continue, it will rise. But what you need to do is prepare for it. And he even said at the end of April, at some point or the other, you've got to learn to operate an economy and live with it. Put sensible measures in place. So I was a bit surprised last night when we didn't see the relief because of all of these conversations that I've had. I remain hopeful that we will get these sorts of announcements over the next few days. But yes, make no mistake, business has been trying their very best to press that message across and to point out, and I think you heard it in the President's speech. He actually said we've heard many complaints and some have pointed out that our regulations are illogical. But within government, there are many of them, they technocratic fiddlers. The way they understand the economy is from that perspective. And we've been trying our best to shed some light on it. We haven't been awfully successful, I agree, but hopefully things will start to change.
Richard Noons from Brights Hardware has a question on the construction industry. Nikki, you did touch on the construction industry. I think if you can just briefly touch on that again, your outlook on the short and medium term.
Unfortunately, again, just like tourism, it is an industry that's already taken a big hit, even before COVID-19. And of course, it's been hurt by the sharp fall in fixed investment we've experienced throughout the Zuma years, and then the acceleration in the pressure on fixed investment activity as a result of all the power outages and the difficulties at Eskom. And now we're dealing with COVID-19. And unfortunately, I think what will hurt the construction industry, in Germany, for example, they've opened construction sites and they've restarted fixed investment. But in South Africa's situation, I think as companies stay under lockdown, most of them didn't have a lot of fat in the system before lockdown struck. Many will run into cash flow problems, and then really the only option and the easiest option is not to retrench people, because people have a human face, and as a firm, it is an asset that you appreciate, and you have great difficulty just causing that sort of pain and difficulty. You only do it if you absolutely have to, if you're a private firm. But so the first thing that will probably happen is they will cut fixed investment. They will delay it, they will postpone it. That will be the easiest thing to do in order to try and survive this situation. And like I say, it won't easily revive because you need demand to pick up. You need spare capacity to be used up before you go to the point where you expand capacity. So unfortunately, it's going to be a tough ride for you. If government does come through on infrastructure spending during the course of 2021, that could change your life substantially. But again, just bear in mind there isn't that much evidence that they've actually delivered.
Ladies and gentlemen, once again, thank you for all the questions coming through. I am keeping an eye on the time, that we do not go over our allotted time. Just to the Nedbank staff, I'm going to hold your questions back. I want to give our clients first priority on their questions, but all the questions will be published afterwards, just to repeat that again, and the slides and the recording will be circulated. Dr. Ivan Meyer from Department of Agriculture, Western Cape. The question is as follows: what are the implications of the loans applications from both the IMF and the BRICS Bank? I'm concerned that the BRICS Bank might open the nuclear deal again with Russia and China. The debt to GDP and the fiscal deficit are unsustainable.
Yeah, no, the debt to GDP and the fiscal deficit is unsustainable, and that limits government's options, and it also, of course, depresses our recovery in the years to come. That's why we've got such a modest recovery, only 3.1% after you shrunk by 7% of that low base. It's partly because government will actually be, it will be a burden on the economy going forward. It also, its ability to actually address those deficits using taxes have been greatly eroded. So the only way to really move to a sustainable path is to undertake the structural change you need to get this economy to grow faster. So hopefully that will sink through in the years to come. I'm very sure they'll first try taxes, But maybe once they've exhausted all other options, they'll come to the conclusion that certain structural changes will have to be made. In terms of the IMF, there's very limited conditionality on the IMF loan. It's the same sort of support they have provided to much poorer countries than South Africa. We see in the rest of Africa. We will not qualify for a moratorium on debt repayment from the IMF because we are, a developing economy as opposed to a less developed economy. So we won't qualify for that. But the IMF comes with virtually no conditionality. So they're not going to have any consequences. As for the BRICS Bank, I don't know. I honestly don't know. It could result in the revival of the nuclear deal, but I have no evidence to actually deny, say yes it will or no it won't. I really don't know.
Simon Killian from Boland Bowers asks whether if we look at the equity markets, and I think particularly the JSE, and Simon, if I can add that, have we seen it at its lowest, and will we see recovery from here onwards? And I think also, will it recover to pre-COVID levels?
Tricky question. All right. So yes, I think we certainly have. I'd be a little bit weary of this run in resources. It's been very quick. And there's going to be some correction in that. Can I tell you when and where that correction will occur? If I could, I would be a billionaire. So obviously I can't. And I'm not sure I'd be sitting here this morning. But I'll be wary of resources. It's had a very quick climb, and it's all related to risk aversion. Remember, it's all related to gold. So I'd rather buy the metal, to be honest with you. And then you either hold it for a long time or you sell it before this year is done. Because I think next year, gold will not look as spectacular as it does now. For finance, for the finance indices and industrials, it's going to be a long road. I think we're probably going to gyrate around that bottom, but I do think the worst of the news is in the price. And I think probably only around the fourth quarter will we start to see markets always move before the good news come. So I think in third quarter, early fourth quarter, as they're anticipating the recovery of 2021, you will start to see industrials and financials move in a more significant way.
Kamal Patundin from Palm Stationery Manufacturers says here, Nikki, the government revenue is going to be severely hit this year. Where does that leave government's ability to provide basic services to those in need? Education, sector, infrastructure, etc.
Remember that a lot of government spending is ineffective. It's inefficient. There's a lot of waste. There's a lot of inefficiency in the system. So, yes, their revenue will be badly affected. And it will be difficult to plug that gap in the years to come. Like I said, I think they'll try taxes, but they're going to find it's not going to be very effective. But the bottom line is that even with the money they've got, there is ways of spending that is far more efficient, that you actually ensure it reaches the people that need it most. And then the other thing to bear in mind is here is the private sector. We are willing to help. And perhaps the path for South Africa isn't one of a big government. It is one of a society working together and helping each other.
There's two questions here that as an industry focus, Nikki. The one is from Junaid Musa from Perth Park on what is the forecast for the healthcare sector. But I want to link another question from Peter Bessinger, Independent Group. His question is also related, I think, to medical, because we see that as an industry that can get through this strongly. But Peter's question is, which industry in South Africa are the best industries through this to address the unemployment challenge that we're going to face now and to give the economy a kickstart?
Okay, so on the first question, just remind me on the industries.
The health industry.
The health industry. Yeah. Okay, on the health industry, yes, you would think that, certainly I think it will be more resilient than say, aviation, than tourism, than hospitality, than the cruise line industry. But it's quite ironic because now with the lockdown, I listened to one of the doctors that are consulting surgeon at Mediclinic in Johannesburg, and was saying that because of the lockdown, they're not allowed to operate, they're not allowed to see patients, they're not allowed to do elective surgery unless it's an absolute emergency. And so in most hospitals, ironically, they're operating at about a 25% capacity. So they've got lots of spare capacity. Our COVID numbers are not that much at this point that they are, being overwhelmed by patients arriving, and they're not getting the other patients coming in because everybody's avoiding hospitals because it could be a hotspot for transmission of the virus. So I think that they will also be hurt, unfortunately, in March and April, but they will probably be one of the industries that will be opened up first because it is healthcare after all, and secondly, they will therefore prove quite resilient. So I think that you're right, they will be one of the resilient and robust industries. As for the next question, just remind me again, I'm getting old.
So apart from the health industry, what other industries do we see as industries that through this will give the economy a kickstart and address the unemployment challenge?
And reduce the unemployment challenge. Okay, so agriculture, absolutely, will be one of the resilient ones. I think they've also been progressive. I think they've been innovative in the way they've gone about things. And that's the key here. We've got to be innovative. We've got to find a way of limiting the health risk while still operating and growing our companies and our markets. And so I think that's certainly been visible in agriculture, food processing and agro-processing industries. Equally, they are big employers and of the sort of labor we have an abundance of, which is your sort of low-skilled to semi-skilled labor. And then services also. We always say services you need essentially very skilled individuals, maybe in banking, maybe in dentistry, but not in hotels, restaurants, all of those other sorts of tourism-related services. And so there is definitely an opportunity for South Africa, given the charm of our people. If we can get and keep it alive, that's the key threat here, keep it alive through this period, I think that is a place or an opportunity where you could absorb a lot of jobs.
Can I link to that last comment, Nikki? This is actually a question from Michael Kowensky from Aroma Management Services, again on tourism and the tourism industry. Exactly on what you mentioned now, should government not provide a tourism sector fund just to retain the skills and the experience and the knowledge in the industry to just keep this industry alive?
I agree, because you're facing such a long challenge, much longer than anybody or any other industry. I would absolutely agree. And again, it's that sort of thing where you can get and raise funds within the private sector, like you've done with the Solidarity Fund, and apply it where it is most needed and where lots of people are employed, where you reach the multiplier effect is quite substantial.
Yeah. Yes, an interesting question from Justin Delahant from Claytile. Thank you for the excellent insights. Does Nedbank see any similarities with what we are now experiencing and the Great Depression of the 1930s?
We're almost scared to consider this idea, but obviously, 2020 is going to look very Great Depression-y like. It's going to have that feeling about it. It's already worse than 2008. But if at this point the analysts are right, then the global economy, and remember, to get a Great Depression, you need everybody to be at the same point of weakness. The global economy actually is healthier than it was during the global financial crisis. Households don't have the debt burden they had during the global financial crisis. And so at this point, there isn't enough evidence to suggest that this could become protracted, which, remember, the Great Depression was. It was multiple years of shrinking output, rising unemployment, falling income, and the evaporation of demand.
Dion Capito from Total Somerset West, or Somerset Mall, makes an observation that during the Zuma years with a lot of policy uncertainty, companies were reluctant to invest, with the assumption that they're sitting on cash. And isn't that now a tailwind for us in this COVID pandemic?
Well, the problem, of course, is I think a lot of that cash have come under severe pressure. It might help us survive, You're quite right as far as that's concerned. But it will certainly be drained dramatically for as long as this lockdown exists in its current form. I'm not saying you shouldn't have a form of lockdown. We need a time to prepare. But I think we are as close as prepared as we can be now. There's actually spare capacity in the health sector. And it is now sensible to very quickly, not at the end of May, but very quickly rethink the nature of this lockdown.
Nikki, can we talk a bit about property, the property market? Charlotte Harvey from SN Pool Eiendomsbeperk is asking, what are your views on property investments and your projections for this year and into next year and the year after?
All right, so, the sad thing about property is, if you think about it, we've had house prices and, certainly in the residential market, remain flat for an extremely long time. And you've got interest rates at record lows. So it's got to be a great time. It's got to be a great time to buy. The only thing sort of working against that and preventing that from happening on scale is the fact that some people will lose their jobs. And we are all uncertain as to what will happen to our income. Whether we'll get the bonus or won't get the bonus, whether we'll see an increase or won't see an increase. And that is, of course, hurting demand. And then the other big cloud hanging on over the South African property industry is, of course, how will government go about expropriation without compensation? And to what extent does it actually threaten private property rights? But otherwise, to answer your question, if you want a better property, this would be the time to do it.
Charles Moller from Touchstone has a question here. I think, Charles, if I understand the question, it's if we look at our SADC neighbours, how they react to the COVID impact and how their economies are impacted, have an impact on South African economy.
Yeah. All right, so clearly their controls are very weak and very poor, and given the level of migration and also just daily shopping, in terms of crossing the border, it does and can prolong our exposure to COVID-19 because we are not all on the same curve. So that's the one side of it. So the controls on that side across the border in the different countries could, have a ripple effect on how long we remain exposed to COVID-19. And then, of course, if it has a devastating effect in that part of the world, you could have two potential outcomes. It could hurt your exports, or it could create heightened demand for South African services and South African expertise. And I would put my money on the latter.
Thank you. There's a question here from Charles de Villiers, also Trade Zone. How confident are you that our commercial banks can continue to support the economy by allowing debt to be restructured until we get out of this crisis?
I am very confident. Most of South Africa's major commercial banks, prior to COVID-19, ran levels of capital adequacy way beyond what was required by the regulator. They sat on, their liquidity coverage ratios were extremely healthy. And clearly this is a testing time and it is a difficult time. But I can assure you that South African banks we have deep markets, we have sophisticated markets, we are not encountering any major liquidity concerns or constraints, and at the same time, of course, the Reserve Bank is providing a substantial amount of liquidity, and they have a tremendous amount of scope to do more if need be. And also, the banks are in constant contact with the Reserve Bank. They're watching us, we're watching them, we're all in this together. I think that is generally accepted. The Reserve Bank's not going to allow any systemic risk to emerge from this crisis.
Loki Governor from Nedbank International's question is, which currency is the safest to hold funds in?
The rand. Of course, the rand. No. Listen, I would be leaning towards Swiss francs, US dollars, and even Australian dollars, because I think the worst is certainly over for them. And they've handled it very, very well, this crisis.
Nikki, I'm going to allow 2 more questions, then we will be out of time. David Gregory from the Kingfisher. Question is in broad strokes, what would you have the government do to kickstart our economy to recover and prosper?
Okay, so the first thing I'll do is I will take a far more flexible approach. I will trust business more. I will do my enforcement. I will do spot checks. I will check up. But I would certainly allow businesses to present plans, and if they can maintain certain health protocols, I'll allow them to operate. I will put the focus on controlling crowds rather than controlling which products you sell and which you don't. That's the first thing. And, of course, I think that would make a big difference because you would have activity across the supply chain, and therefore you'll have less of these big bottlenecks building up that we'll only have to deal with once the lockdown is actually lifted. And so it has a ripple effect, and it claims another quarter and another quarter. So that's the first thing I'll do. Secondly, I think government's done quite the right thing in terms of supporting those who have lost their jobs and the most vulnerable in society. I think it's very important. After all, if you do not respect humanity, you cannot be successful as an economy. So at least that bit we have under control, and that looks good. And then the other thing I would do from government's perspective is while we're in this crisis, I would revisit some of that structural changes that are so badly needed to lower the cost of production in South Africa and to reduce the regulatory and legislative burden on companies, lower compliance cost. And there you go. You've got all the time in the world. Only half of government's open. You can work remotely. You can just go and wipe them out and get rid of all of that red tape and make this system, while you are in this process, undertake some of those structural changes so that when we open up, already you've done quite a bit to boost confidence. And then the Reserve Bank, I think, has also been doing the right thing, and like I say, they'll continue to stimulate. They will, of course, only provide a benefit once the economy is open. So the key for me is deal with the lockdown in a sensible way.
Thank you, Nikki. I kept Keith Scott's from Personal Trust question for last. I think it's a tricky one. The question is, are there any major positives for South Africa going forward?
Well, in the numbers, no. I mean, if you just looked at economic facts and figures, you would say no. But we all know that a company is more than just the sum of its assets. We know a country is more than just the sum of its assets. And I think the one thing that we are seeing, even as bankers, is that South African firms are creative, they are resilient, they are tough, and this is not our first crisis. We've seen this movie before. It's terrible for the Americans. They're used to stability. But we, on the other hand, are far more resilient than that. And, I think working together, the positive is we might emerge from this stronger and maybe leaner and more efficient economy at the end of the day.
Nikki, as always, thank you very much for your insights and for your time. Ladies and gentlemen, we really appreciate your time today. Thank you for the participation. It was really great to receive all the questions. As mentioned, we did not get to all the questions, but we will circulate the recording and all the questions as well as the relevant answers. Ladies and gentlemen, everyone on the webinar today that are not from Nedbank do have a relationship with Nedbank in some or other way. Whether you're doing all your banking with Nedbank, or part of your banking, or you started to build a relationship with one of the Nedbank staff members. I want to encourage you that if you have any questions in this time of crisis, to reach out to your bankers, your business managers in business banking, your relationship bankers in professional banking and small business banking are ready to assist where we can. Not just in terms of funding to relieve cash flow pressures, but also to provide advice and solutions that can enable your business to embrace the digital economy and to digitize, which is nowadays an imperative as we go into the new normal. We've got great digital solutions and innovation that can enable your business and carry your business through this time. Nedbank is also a proud participant of the government-backed COVID-19 SME loan scheme. And we want to encourage you that If you need to, please make contact with our bankers to determine whether you qualify for this. Ladies and gentlemen, once again, have a wonderful day. Thank you very much and stay safe.